right now, the world's most powerful central banks are doing something they haven't done since 1996. They aren't just buying gold, they're setting a trap. While retail investors were distracted by the latest AI stock rally, the value of gold held by foreign central banks quietly crossed the $4 trillion mark. For the first time in 3 decades, gold has officially surpassed U.S. Treasuries as the world's largest reserve asset. This isn't a coincidence. It's a calculated exit. Today, we decode the logic behind the great gold reversal of 2026 and why the safety of the US dollar might be the most dangerous trap in your portfolio. For 80 years, the global economy had a simple rule. If you want safety, you buy US debt. But in March 2026, that logic has flipped. Why? Because the US debt has just hit $38 trillion. Interest payments alone are now costing more than the entire defense budget. Central banks in China, India, and even Europe are looking at this math and realizing the same thing. The dollar is no longer a risk-free asset. It is a return-free risk. Look at the data. China has now extended its gold buying streak to 16 consecutive months. They aren't dumping the dollar in a panic. That would crash their own economy. They are performing a silent divorce, slowly trading paper promises for physical certainty. But here is where the trap is actually set. It's called the unit. As of early 2026, the BRICS nations have moved their digital trade prototype into the pilot phase. Unlike the dollar, which is backed by nothing but faith and credit, the unit is 40% backed by physical gold. This changes everything. For the last century, if you wanted to buy oil, you needed dollars. If you wanted to trade globally, you needed the dollar-based SWIFT system. But by hoarding gold, these nations are building a monetary lifeboat. They are creating a parallel system where they can trade energy and goods without ever touching a US bank. If the US decides to freeze your assets, like they did to Russia in 2022, gold-backed trade means your economy doesn't stop. It makes sanctions irrelevant. Many analysts called gold a dead asset when it was at $2,000. Now that we've crossed $5,000 an ounce, the same people are calling it a bubble. But at Cap's logic, we look at the structural demand. Central banks are price inelastic. They don't buy because the price is low. They buy because they have no other choice. The Federal Reserve cut rates earlier this year to manage the debt. They signaled to the world that they will always choose inflation over a default. It doesn't have a printing press. It doesn't have a CEO. And most importantly, it has no counterparty risk. In a 2026 world of AI-generated deepfakes and digital fraud, gold is the only thing that is exactly what it looks like. So, is the dollar dead? No, not yet. It's still 58% of global reserves, but the momentum has shifted. The gold trap isn't for the central banks. It's for the people who believe the old rules still apply. The biggest players in the world are positioning for a future where the dollar is just one of many options, rather than the only option. If you want to survive this transition, you need to stop thinking like a consumer and start thinking like a central bank. Diversify, stay logical, and don't get caught in the trap. I'm Cap's Logic. If you found this analysis valuable, subscribe to join the 1% who see the markets for what they really are. See you in the next deep dive.